the main topic of semi-final Lesson 3.0 report, which will be reported by I, Marian Guria, Jonas Arseno, and Marcelo Cuesto. So this main topic was entitled Gains and Losses from Dealings in Property. So when you hear about gains and losses, what will come up from your mind? So let me define gains and losses for you. A gain is a general increase of the value of an asset or property. A gain can be contrasted with a loss, which occurs when property or assets held lost value compared to their purchase price. This topic has 4 subtopics. The first one is the ordinary asset. Second, capital assets. Third one, measurement of gain or loss. And the fourth one is ordinary gains versus capital gains. Dealings in property. The term dealings in property refers to the disposal through sale or exchange of A, ordinary assets, or B, capital assets. Gain realized on the sale or exchange of property is included gross income, or unless excluded by the law. For this purpose, property includes tangible items. When you say tangible items, it is capable of being touched, such as building. And intangible items, when you say intangible items, unable to be touched or grasped, or not having any physical presence. So, for example, goodwill. Generally, the gain is the excess of the amount realized over the unrecovered cost of their basis for the property sold or exchanged. So the dealings of property have sub-topic, which is the ordinary assets or the capital assets, which will be discussed by Jonas Arseno and Marcelo Cuesto.
So the next will be the ordinary assets. So if we are talking on ordinary assets, refers to all real properties specifically excluded from the definition of capital assets under Section 39 of the Code, namely the stock in trade intended for the sale normal course of business, such as merchandise inventory or securities held or being sold by dealers in securities, which means merchandise inventory is the account on a balance sheet that reflects the total amount paid for products that are yet to be sold. As a current asset, merchandise inventory is a basically holding account for inventory that's waiting to be sold. It has a normal debit balance. So when debit increases, the credit will decrease. And real properties acquired by real estate dealers or developers. Real properties used in trade or business, including real properties held for rent. An ordinary asset is any asset that is not a capital asset or a business asset. I don't believe there is a specific code definition for an ordinary asset, but they would what is left after excluding capital and business asset. Examples of an ordinary asset would include cash, account receivables, most inventories, prepaid expenses, office supplies, and others. In general, these assets are classified as current assets or a balance sheet. So let's move in capital assets. So if we're talking capital asset, shall refer to all real properties held by a taxpayer whether or not connected with his trade or businesses, and which are not included among the real properties considered as ordinary asset under Section 39. So I have here an example of a capital assets. The stock and securities held by taxpayers other than dealers in securities, interest in partnership and joint ventures, investment property, and the goodwill. So capital assets are significant pieces of property such as homes, cars, investment properties, stocks, bonds, and even collectibles or art. For business, a capital asset is an asset with a useful longer than a year that is not intended for sale in the regular course of the business's operation. This also makes it a type of production cost. For example, if one company buys a computer to use in its office, the computer is a capital asset. If another company buys the same computer to sell, it's considered a inventory. So let's now move measurement of gain or loss. Gain exists or of amount realized basis or adjusted basis, which means gain is a general increase in the value of an asset or property. A gain is rises in the current price of something is higher than the original purchase price. A gain can be contrasted with a loss, which occurs when properties or assets held lose values compared to their purchase price. And the loss excess of basis or adjusted basis, the amount realized. A tax loss occurs when the total expenses are greater than the total revenues under the tax reporting rules of the applicable government jurisdiction. Businesses and individuals will frequently reduce their reportable revenues or increase their reportable expense for tax purposes in order to reduce their tax payments. So let's now talk the measurement or of gain or loss. Capital gains or losses result from selling capital assets which generally but not always includes the sale real estate. So the amount realized sum of money received plus if MB of the property received. So which means amount realized is the amount received from the sale of an asset or financial instrument. Amount realized is different from amount recognized, which is defined as taxable income received or deductible loss.
So we can move to the number 4, which is ordinary gain versus capital gain. So the first one is ordinary gain, derived from sale or exchange of ordinary assets. So it is the gain that realized from the sale or exchange of ordinary assets, including gains performances of services and business. And the second one is capital gain, excess of value received over the determined cost from the sale or exchange of a capital asset. It is the gain from the sale or exchange and other disposition of a capital asset. So we can move to the last slide, which is net capital gain and loss. So the first one is net capital gain. So what is net capital gain? Net capital gain excess of the gains over the losses on sale or exchange of capital assets during the taxable year. And the second one is net capital loss. What is net capital loss? Excess of the losses over the gains on sales or exchanges of capital assets during the taxable year. I forgot to discuss the ordinary loss and capital loss. So this two is like the same definition of the first slide we discussed about ordinary gain and capital gain. So what is ordinary loss? So ordinary loss is incurred from the sale or exchange of ordinary asset, and also means the excess of deduction over the gross income of a taxpayer during taxable year or net operating loss. And the second one is capital loss, which is loss from sale, exchange, or other disposition of capital assets. So gains and losses may be classified ordinary gain and capital gain.
Important notes: cost basis in determining gains or loss from sale or disposition of property. So when you say by purchase, it must be in actual cost. By inheritance, FMB. By gift, same as it will be at the hands of the donor or last preceding owner. Except if cost basis is greater than FMB, and then cost basis shall be FMB, so whichever is lower. Acquired for less than adequate consideration, so it will be amount paid from transferee. If acquisition cost is increased by improvements materially added, so it will be adjusted basis of 1 to 4, either actual cost, FMB, same as it will be at the hands of the donor or last preceding owner. And the last one is acquired under a previous tax-free exchange. So, that will be all for our topic. Thank you for listening. For any questions, clarification, don't hesitate to message me or Jonas or Marcelo. That's all. Thank you.
Good day, everyone. Let me introduce myself. I am Marilyn Tolomia. As you can see on the screen, our topic today is all about allowable deduction. So at this point, we will talk all about the definition of the allowable deduction. So what is allowable deduction? An allowable tax deduction is the amount you paid for something which is connected with the work you do to earn for your income. On the other hand, a deduction is an expense that can be subtracted from a taxpayer's gross income in order to reduce the amount of income that is subject to taxation. For example, if you earn 50,000 in a year and make a 2,000 donation to charity, during that year, you are eligible to claim a deduction for that donation, reducing your taxable income to 48,000. In this topic, why is it important to have allowable deduction? Well, it's incredibly important to be thorough if you decide to file with allowable deductions, since there is always a chance you could be audited. Claiming allowable deductions on your federal tax return can lower the amount of taxes you owe since it reduces the gross amount responsible for paying taxes and overall. So how allowable deductions calculated? The allowable deductions calculated by deducting annual allowable deductions from the total amount of gross income for an income year. There are basically two types of allowable deductions, such as the standard deductions and the itemized deductions. Taxpayers have a choice of taking a standard deduction or itemizing deductions. Hence, the taxpayer should use the type of deduction that results in the lowest tax. So the definition of the standard deduction. Standard deduction is a fixed amount allowed by IRS to the taxpayers. The government sets the amount of standard deduction amount every year for each filing status. These amounts are different according to their filing status. So there are five standard deductions based on the filing status, whether you are single, married filing jointly, married filing separately, qualifying widow or widower, head of household, single but with one or more dependents. Note, all of these statuses have different qualifying rules, standard deductions, tax rates, and credit and deduction eligibility. So the second type of allowable deduction is an itemized deduction, which is a tax deductible expense that you paid in a tax year. Only specific expenses defined by the Internal Revenue Service can be itemized. Itemizing involves reporting your expenses for specific types of allowable deductions, adding them all together, then entering the total on your tax return. The itemized total is subtracted from your taxable income. If you plan to itemize, you should keep track of your qualified expenses during the year. Keep your receipts and other documents to show that these expenses are legitimate in case the IRS asks for proof. So generally, you can claim itemized deductions in the following categories, such as medical and dental expenses, state and local income taxes, real estate taxes, home mortgage interest, gifts to charity, and lastly we have the casualty or theft losses. So there are two examples of allowable deductions, such as fully allowable expenses and partially allowable expenses. The definition of the fully allowable expenses. The IRS defines these types of expenses which you can deduct at 100% of their value as expenses that are ordinary and necessary. There are things that are directly tied to your business and that you couldn't conduct business without this. Examples: office supplies, office space, utilities, work-related travel expenses, work-related automobile expenses, insurance, employee salaries and benefits, advertising and marketing, licenses, permits and subscriptions, charitable donations, and meals. The definition of partially allowable expenses. These expenses are related to your business, but only a specified percentage can be deducted. The primary example for this is gifts. If you want to express your appreciation to a client or an employee with a gift, keep in mind you can only deduct up to 1,200 of its value. It's also important to remember that tax laws change frequently. Just because something qualified as an allowable deduction in the past doesn't mean you were automatically in the clear to write it off. The standard itemized deduction amount also changes. Stay on top of the current tax code to ensure you're making the best decisions of your business. As a taxpayer, if you're not sure what qualifies as an allowable deduction, be sure to consult the IRS website or enlist the service of a professional accountant. That's all. Thank you.
Deductions from the gross income. Our income tax system allows deduction for various items, especially expenses incurred necessary to produce the income. This is to provide taxpayers with a more equitable tax base and true measures of income. Deductions from the gross income have 13 categories. First one is ordinary and necessary trade, business or professional expenses. Second is taxes. Third, interest. Fourth, losses. Fifth, bad debts. Sixth, depreciation. Seventh, depletion of oil and gas wells and mines. Eighth, charitable and other contributions. 9. Research and development. 10. Pension trust. 11. Additional requirements for deductibility of certain payments. Next is optional standard deduction, and last one is premium payments on health and or hospitalization insurance of an individual taxpayer. Ordinary and necessary trade, business or profession. In general, there shall be allowed as deduction from the gross income from all the ordinary and necessary expenses paid or incurred during the taxable year, which are directly attributable to the development, management, operation, and or conduct to trade, business, or exercises of profession. Ordinary expenses are expenses which are normal or usually in relation to the taxpayer's business and surrounds circumstances. On the other hand, necessary expenses are expenses which are appropriate and helpful in the development of taxpayers' business and are intended to minimize losses or to increase profits. Examples of ordinary and necessary expenses are salaries, wages, allowance and other forms of compensation. Next one is travel expenses, rentals, entertainment, amusement, and recreation expenses. Taxes. Tax expense or tax paid or incurred within the taxable year in connection with the taxpayer profession, trade or business shall be allowed as deduction from the gross income. In a case of a non-resident alien individual engaged in the trade or business in the Philippines and a resident foreign corporation, the allowable deduction for taxes provided in a tax code shall be allowed only if and to the extent that they are connected with the income from sources within the Philippines. Examples of deductible and non-deductible taxes. Deductible income tax paid abroad claimed as operating expenses, documentary stamp taxes, occupational taxes, excise taxes, import duties, local business taxes, and percentage taxes under the tax code except Section 127 A and B, otherwise known as the stock transactions taxes. And the non-deductible taxes are Philippine income tax except French benefit tax, include income tax paid abroad, claimed as tax credit, estate and donors taxes, percentage taxes under Section 127 A and B, otherwise known as stock transaction taxes, value added tax, and taxes not related to business,
trade or profession. Interest for unpaid taxes. Interest paid or accrued on tax related to business of practice of profession, such as those paid for deficiency or delinquency. Since taxes are considered indebtedness, are deductible as interest expense, provided that the tax is deductible tax, it is a deductible in full. It shall not be reduced by 33% of interest income subject to final tax. However, fines, penalties, and surcharges are on account of taxes are not deductible. Deductible interest expense may include interest paid by a corporation on scrip dividends, interest on deposits paid by authorized banks of BSP to depositors, provide the appropriate tax was withheld, and interest paid by a corporate taxpayer who is liable on a mortgage upon real property of which the said corporation is the legal or equitable owner. Interest. Interest expense was defined under related revenue regulation as a payment for the use of or forbearance or detention of money. Regardless of the name of it is called or denominated. It includes the amount paid for the borrower's use of money during the term of the loan, as well as for his detention of money after the due date of its repayment. Non-deductible interest and losses related to taxpayers. Interest expense as well as losses are not allowed as deduction from the gross income if both the taxpayer and the person to whom the payment has been made or is to be made are a. Between members of family. The family of an individual shall include only his brothers and sisters, whether by the whole or half-blooded, spouse, ancestors, and lineal descendants. B. Except in case of distributions in liquidation between an individual and corporation more than 50% in value of the outstanding stock of which is owned, directly or indirectly, by or for such individual. C. Except in case of distribution in liquidation between two corporations more than 50% in value of outstanding stock of which is owned, directly or indirectly by or for the same individual, if either one of such corporation, with respect to the taxable year of the corporation preceding the date of the sale of exchange, was under the law applicable to such taxable year. A personal holding company or a foreign personal holding company. D. Between the grantor and a fiduciary of any trust. E. Between the fiduciary of a trust and the fiduciary of another trust, the same person is a grantor with respect to each other. F. Between a fiduciary of a trust and beneficiary of such trust. Losses. Losses may be offset against all income and capital gains in the same tax year. However, losses are deductible from gross income only on the following grounds. A. Ordinary losses arising from the losses incurred in trade, business, or profession including net operating loss carryover. B. Casualty losses. Casualty losses are not allowed as deduction from the gross income if such losses have been claimed as deduction for estate tax purposes in the estate tax return. Charitable and other contribution. Contributions deductible from gross income may be deductible in full or subject to limitation depending upon the organization to which the donation is given. The amount of any contribution of property other than money shall be based on the acquisition cost of said property. Research and development expense. A taxpayer may treat research or development expenditure which are paid or incurred by him during the taxable year in connection with his trade, business, or profession as ordinary and necessary expense which are not chargeable to capital account. The expenditures so treated shall be allowed as deduction during the taxable year when paid or incurred. Research and development shall not apply to. First one is any expenditures for the acquisition or improvement of land or for the improvement of property to be used in connection with research and development of a character which is subject to depreciation and depletion. And second one is any expenditure paid or incurred for the purpose of ascertaining the existence, location, extent, or quality of any deposit of ore and other mineral, including oil and gas. Pension trust. Pension trust contributions pertains to deduction applicable only to the employer on account of its contribution to a private pension plan for the benefit of its employees. This deduction is purely business in character, established or maintained by employer to provide for the payment of reasonable pensions to his employees. Present service cost or normal cost and past service cost. Contribution during the taxable year to cover the pension liability accruing during the taxable year is known as present service cost or normal cost. Such deduction is allowed as deduction as expense in general. On the other hand, past service costs pertain to an amount paid in excess of present service cost, covering pension liability pertaining to old employees that accrued during the years previous to the establishment of the pension trust. It is allowed as deduction and apportioned in equal parts over 10 consecutive years, beginning with the year in which the transfer or payment is made. Premium payment on health and or hospitalization insurance of an individual taxpayer. Premium payment on life insurance of employees taken out by the employer or corporation. Premium payment on life insurance of employees taken up by the employer or corporation may be allowed as deduction from the latter's gross income provided the designated beneficiary is the employee or his or her heir or beneficiaries. Premium payment or proceed from life insurance. First one is beneficiary is the employee or heir. Deductible expense of the employer and taxable income of the employee. Then proceeds to be received by the employee's heir is exclusion from gross income. Second is beneficiary is the employer. Non-deductible expense of the employer. The proceeds of the life insurance to be received by the employer or corporation shall form part of its taxable income.
Good day, this is my topic. Our business expenses and losses incurred which the law allows to reduce gross business income to arrive at net income subject to tax. In times of conflict with whether an expenses is deductible from gross income or not, the role of deductibility should be strictly construed against the taxpayer. Kinds of allowable deduction. Itemized deduction, business expenses, interest, rediscussion, taxes, audition, losses, pension trust, charitable contribution, research, and premium payment for health and hospitalization insurance. Types of allowable deductions. Optional and standard deductions or OSD in lieu of itemized deduction, except premium payment for health hospitalization insurance. The taxpayer may claim optional standard deduction equivalent to the following. For individual taxpayers, 40% of gross sales and revenue. For corporate taxpayers, 40% of total gross income. In case the taxpayer opted the deduct the OSD, the deductions claim may not be substantiated by adequate evidence. Only documents supporting the computation of gross income should be substantiated. Application of optional standard deduction or OSD. A taxpayer who elected to avail of the OSD shall signify in his or its return such intention. Otherwise, he or it shall be considered as having availed himself of the itemized deductions allowed under Section 34 of the Code. Once the selection is made, the same type of deduction must be consistently applied for all succeeding quarterly returns and in the final income tax return of the taxable year. Importance of allowable deduction. It's incredibly important to the truth if you decide to file with allowable deduction, since there's always a chance you could be audited. Claiming allowable deduction on your federal tax return can lower the amount of taxes you, since a reduction of gross amount you're responsible for paying taxes on overall.